Hi everyone, I'm Nicole Colantoni and I'd like to welcome you to the annual Roadshow webinar. You will first hear Chief Investment Officer Steve Johnson reflect on the past 12 months' performance and provide some insights into the current portfolios. Gareth Brown and Alex Shevelev will then follow Steve to discuss portfolio positioning for the coming year. If you are viewing this live today, you can send us in questions during the course of the discussion. Use the panel on the right-hand side of your screen. We have set aside some time at the end of the session to answer them for you. Firstly, some important compliance information. On the screen, you can see the general advice disclaimer. Please note, anything you hear today is general advice only and does not take into account your personal circumstances. Please seek professional advice if you are in fact considering an investment. Today's presentations will commence at 12:05 p.m. and will conclude just after 1 p.m. with Q&A with the panel. I won't waste too much time on the introduction, but Steve founded Forager back in 2009 and has been the company's Chief Investment Officer since. Without further ado, welcome Steve.
Thank you, Nicole, and I'll just add my welcome to Nicole's. It's great to have you online today. It's been a fantastic couple of weeks traveling around the country and catching up with a lot of Forager investors and potential investors. It's good to be back home in Sydney, but also good to be doing this last webinar with everyone online. My section is going to be about the past year of performance for the most part, and also some reflection that we've done on the past 9 years of performance. But let's kick things off with the numbers first. Both of our portfolios had decent years in absolute terms, but poor years in relative performance terms. I said in the quarterly report that's just gone out, any year you make money in the stock market is a good year, and any year you make 7 or 8% should be seen as a perfectly normal one. But the 2018 financial year was a year in which stock markets, both locally and globally, did much better than the 7 and 8% returns that our funds made. You can see the Aussie fund there, 6.5% for the year, net of all fees, versus the All Ords index at 13, almost 14%. And internationally, it was an 8.8% year versus just over 15 for the MSCI World Index. As we'll talk about a little bit later, both of those were with the benefit of some currency assistance. The long-term returns for both funds are still very good. You can see here a chart for the Australian fund since inception. Someone who invested $10,000 back in 2009 when we kicked off is sitting on an investment balance of about $32,000 now. That's assuming reinvestment of all distributions. And in the international fund, it's only been going for 5 years. An investor there who had invested $10,000 at inception is sitting on a balance of about $22,000. So the returns there have been very good for both. You can see in the respective charts that while the returns for both funds have been fairly even with each other, the tailwind for international equities has been much stronger than the tailwind domestically. So that international fund there is roughly in line with the index over the 5 and a bit years since inception, whereas the Australian fund has been significantly ahead of its index. I'll get into the stock specifics in a moment, but there were a few other factors at play over the course of the year. Firstly, we held a lot of cash in both portfolios. But this has worked both ways for us over the years. I think in the Australian fund, we've probably had 3 occasions where we've had a lot of stocks have the investment case work out. We've sold them, and while we were looking for opportunities and sitting on a lot of cash, the market was kind to us and either retracted or at least some sectors offered up plenty of opportunities. This past year, it certainly hasn't worked in our favour. You can see on the charts there, the Aussie fund started the year at about or a bit over 15% of cash. That went up substantially over the subsequent 4 months as we sold stocks like ServiceStream and Jumbo Interactive that we've held for quite a long time. And in the international fund, we'd already been through that process leading up to 30 June. It took us quite a while to put that cash to work. The big difference on there is that we have been able to find quite a few opportunities in the last 6 months of the year in the international fund. We've got a few new holdings as well in the Australian fund, but they have been offset by further selling in that portfolio. I've said this a number of times over the years, our aim is to be mostly invested most of the time. I don't like sitting on huge chunks of cash for long periods of time. Mostly invested means 10 to 20% cash. You should expect a value investor like us to want to, or to keep ammunition on the sidelines for opportunities when they come along, particularly in less liquid portfolios. You don't want to be selling one idea to buy another one when the opportunities are there. So 10 to 20% cash is perfectly normal, but these levels of 30% are not. Most of the time means I think we should be in that range in 8 years in 10. 1 year in 10 will be less when there's lots of opportunities, and 1 year in 10 will probably be more because there are not many opportunities. We haven't really lived up to that, particularly in the international fund. We've held more cash than we would like for extended periods of time. That has been a function of markets rising fairly consistently globally and making it difficult to put that money to work. And also, I think internally, we can be more active about this cash weighting and make sure that when we sell our stock, we're thinking about the best place to deploy that money, be it other opportunities that we might be able to add little balances to, or working harder to find those new opportunities before we exit the maturing ones from the portfolio. The other big factor over the past year has been that value investing has been a difficult place to be invested. This chart shows you the world index split into value and growth, and the same here in Australia. It has been a year where you wanted to own growth stocks, certainly in terms of share price performance, and that hasn't helped us. I've seen a lot of value investors rolling this slide out, and I think it's really important that it's not an excuse for us. We have mandates that are very flexible. We can and do own a wide spectrum of stocks, including some that grow, but it's worth noting that it has been a very difficult period. And this has been 5 years really where growth stocks have performed well. If you look back over 50 or 60 years, value has fairly meaningfully outperformed growth in every decade, except for the past 5 years and the past year in particular. Some of these things are real changes to the economy. There's a substantial amount of advertising spend shifting from traditional value businesses in the media space to new and growing businesses like Google and Facebook. Like any of these things, though, it gets up a momentum of its own, and some of the behaviour we're seeing internationally, but particularly here in Australia in the growth space is craziness. There are people paying extraordinary values for businesses that in some cases I don't even see a clear path to revenue, let alone a clear path towards the profitability that you would need to justify those sorts of valuations. So look, not excuses for us, either of those things, the cash or the value, but a couple of important factors for you to take into account. So moving on to the stock specifics, which is always far more important for us. I said previously that value space has been underperforming for most of the past 5 years, and we've managed to make good money because we've been able to find the right businesses over that period of time. This is a comparison of the contribution to performance in 2017 versus 2018 for the Australian fund, and there's a couple of important differences there. One, if you look at the scale at the top, the magnitude of the big wins was much less in 2018 than it was in 2017. And this is really common for us. We make our money when stock ideas work out. We run a concentrated portfolio, so when they do work out, they can make a significant difference to portfolio performance. But we've just had a year where we didn't have any of those dramatic winners in the portfolio, whereas the year before we had 3 stocks, Silverstream, Macmahon and Jumbo, that all contributed more than 5% to portfolio performance alone. And then down the bottom end of that chart, you can see it was a longer list of stocks that didn't perform well for us in 2018 versus a small handful of them in 2017. A couple of stocks on that right-hand side, or on both sides actually, that have contributed to performance for a number of years for us now. We owned both Silverstream and Jumbo Interactive back in 2013 and 2014. They've been fantastic investments for us, added significantly to performance over a number of years. They are both businesses that we expect to continue growing, but the share price has caught up with those expectations around growth, and we've sold both of them from the portfolio. In terms of things that have contributed to performance outside those two, Macmahon was the largest contribution in 2018. It was also a big contributor in 2017, but unlike those other two, it's one that is still in the portfolio, and in fact, it's still our largest position. The business has performed very well over the past year. We were sitting here this time last year saying we can see a path here to substantially higher profitability, but there are a lot of hurdles that need to be jumped over before we're going to get confident in that. We have jumped over quite a few of those hurdles, particularly their biggest contract that they announced when they were under takeover from CIMIC last year is the giant Batu Hijau mine up in Indonesia. That has started in the last 3 months of the year. It started its full phase of operations, and we will see in the results when they come out in August that's contributing meaningfully to revenue already. They had a loss-making contract at the Telfer mine that they seem to have stemmed those losses, and they've won a couple of other new contracts throughout the year. So it's a business where the stock price is up. I don't think it's up as much as the underlying business fundamentals would suggest. And this next year for them is going to be very important. It's almost certain that the revenue number is going to double. We just need to make sure they're disciplined on the operational side of things and that they deliver margins. We can see $80 million of EBIT there potentially in 2019 and a current valuation for this business of about $400 million. So it could look very cheap still this time next year. Boom Logistics, the share price here was up 150% over the year. We didn't have anywhere near as much invested in it as we did in McMahon, so that's why its contribution wasn't as large. It's a business that we bought at a very steep discount to the replacement cost of its cranes. It works those cranes mostly on behalf of mining companies, but increasingly in wind farm construction as well. The mining market has improved over the past 12 months or so. The renewable energy space is very buoyant, so both of those things have been positive for the business. You'll see in its results, I mean, they're hoping to get close to breaking even rather than any sort of dramatic results here. This is not the world's greatest business. It's done well for us because of the price we bought it at rather than any sort of exceptional performance, and we've taken some money off the table there across the course of the year. Alex Chevrolet is going to come on later and talk about iSelect, so I won't steal his thunder here, but it was a positive contributor to performance. If you look at the 12-month share price chart, it's down by more than half over that 12-month period. We were buying it late April, early May when the share price was in the 50s, so it has contributed positively. Alex will talk more about that later. And finally, Thorn Group's the largest negative contributor to performance. It's been a difficult investment for us, one that we've continued to add to over the course of the year, and one that we think there is still a lot of value in it we can do well out of over the coming years. There's a few different divisions here. They've actually sold a couple of those and repaid their debt down to something that we think is quite manageable. They have an equipment finance business that they are still growing that we would also like them to see them sell. And really we want them to focus on their retail business, which is the Radio Rentals brand. It is in a difficult position at the moment. They've had a lot of regulatory troubles. They've got a class action there about lending money to people that they shouldn't have been lending to. So there's a few more things that still need to be cleaned up in this business, but we do think it has a place in the world, and the stock is trading at half of its tangible asset backing now. We think it should be worth at least that tangible asset backing, if not more, but it has been a significant negative contributor to performance over the year. The distribution was very significant this year, 21.5 cents. Most of that is a function of stocks that we'd owned for many years that we sold during the year, particularly, again, ServiceStream and Jumbo Interactive. You can see down the bottom there was a small contribution from imputation credits. Jumbo paid some fairly large special dividends during the year, fully franked, and ServiceStream was a big fully franked dividend payer as well. So that will add a little bit to investors' tax returns for the year. It's not something to focus on in terms of what we're doing in this fund. Most of the investing we do is for the purpose of capital gains, and you should view it as the capital gains part of your portfolio rather than a regular, reliable dividend payer. Because it is a trust, though, when we make profits and realise those profits, we pay them out to investors. So the past year, that distribution is really a reward for some of the gains that have been made over the past few years. And on the right-hand side there, you can see the trading price relative to net asset value. It's traded at a pretty consistent premium to its NTA over the course of the year. I know that is frustrating for investors who are keen to access an investment in this vehicle. I said last year that patience will probably pay. It hasn't turned out to be the case over the past 12 months or so, but I still view that as the most logical strategy here. Moving on to the international fund, it was a little bit of a same story, really. This is the same chart as we had for the Australian fund, comparing 2017 with 2018. Couple of big differences there. The magnitude of the gains was, again, very significant in 2017. We had a lot of 24 and LN that were close to or more than 5% individual contributors. And remarkably, in 2017, we didn't have a significant negative contributor to performance. As Gareth wrote in the performance report last year, we were unlikely, if ever, going to repeat that. And you can see in 2018, it certainly wasn't the case in 2018. We had one very significant negative contributor there in Technicolor. And again, a bit like the Australian fund, the magnitude of the wins was not as significant as it was the year before. Running through some of those individual contributors, the largest positive contributor to performance for the year was a stock called PGS. You probably won't have read a lot about this. It's been a fairly small investment in the portfolio. And in fact, we had sold it in June and July last year. This business is an oil and gas services company. They drive boats around the ocean and tow streamers around that collect data for oil and gas exploration companies. They're called seismic businesses. And that seismic industry has been under enormous stress. It's the first industry that suffers when the oil market turns down. And this company, like others in the industry, had quite a bit of debt. In June and July, we were very concerned that the market wasn't going to recover quickly enough for this business to be able to manage its balance sheet. So we sold our investment. We actually met with the company in Oslo in September last year and were convinced that we've made the right decision. The management was quite depressed. It looked like they were highly likely to breach covenants by the end of the year. So why was it one of the significant contributors to performance? Well, I was sitting in the office in early January and got an email through from PGS that was an update on its late sales. And this is, even right through the crisis, they were still driving their boats around the ocean collecting data. They just weren't selling a lot of it. But in November and December, they had sold quite a bit of data from previous collection periods. That brought in some much needed cash flow. It relieved their covenants, and the commentary was very positive about the market improving. The share price was up 20% on that announcement. I thought it should have been up 100%, and we quickly re-established an investment in the company there. And over the course of the 6 months since, its share price has more than doubled. So that's why it's the top of the contribution list. It's still in the portfolio. We have taken a little bit of money back off there as the stock prices run so hard. Technicolor, it was the largest negative contributor, and it was a very significant hit to our performance for the year. In fact, it represented more than half of the gap between our performance and the index's performance. We wrote a lot about this in the March quarterly report, so get yourself a copy. It's on the website if you haven't read that. I'll keep it fairly brief here. This business has 4 divisions, and we had valued them all and added them up. Pretty much, it hasn't been good news on any of those fronts. They've sold one of their businesses for less than our lower end of the valuation. They have a very large set-top box and modem business in the US. It's a huge amount of revenue. They've got fixed price contracts in that division. Unfortunately, they've agreed to fixed prices on the revenue side of things, but they haven't fixed their costs, and the price of one of their main inputs, which is memory chips, has doubled and tripled over the course of the past 12 months. They are claiming that as bad luck. That's costing them 80 to 100 million euros a year of profit at the moment. I also think it's very poor management to let the company get into that situation. They have a world-class VFX business, this is video special effects. Demand is very buoyant in that industry with Netflix, Amazon, lots of companies wanting to create high quality content. Revenue is growing there. It's not growing as fast as we had anticipated, or indeed as fast as we think it should be growing, and it's probably suffering from some of the issues elsewhere in this business. So a trio of issues there that have combined with the company's significant amount of debt to send the share price down by 2/3 over the course of the last year. Value investors are very prone to hanging on to stocks more in hope than in rationale. We want to be very careful not to do that here. We have reassessed the investment from first principles. I went and met with the management team in Paris in March. We think there's a very strong case for holding on to our investment here. And in fact, if we see some signs of improvement, we will increase this position again. The main reason being its debt is not due until 2023 and it has absolutely no covenants on it. So this business has time to repair itself and it has a lot of revenue with which to work as well. Moving on to a more successful story. This is Lotto24, a company that we've owned for a number of years now, and it was our main contributor in 2017, and it was a good 50% share price appreciation again in 2018. This business hasn't done anything other than what we expected when we first bought it back in 2014. We had a pretty clear path here in terms of understanding the value that Lotto24 was creating. It was being missed by the market. I'll touch on it a little bit more later, so I'll keep it brief here. In short, though, the share price is now trading at pretty close to our estimate of fair value, so we've been slowly taking money off the table there across the course of the year. And foreign currency was a headwind in 2018. It was a tailwind in 2013. The Aussie dollar has been weak against most major currencies around the world, particularly against the yen and the pound and the euro. And that was about a total 3.5% positive contribution to our performance from FX. We run an unhedged back to Aussie dollar portfolio here. We think it's a key feature of the fund that you get exposure to foreign currencies, and we don't really see any reason to change that at current levels of the Aussie dollar. If it really fell out of bed and was trading in the 50s, we may look at reconsidering that, but for most of our investors, they want this exposure to foreign currencies. So that's a review of the past year of performance. We've actually done a bit of an exercise internally over the past year of looking back at the past 9 years of performance and trying to look at what's been working and what hasn't been working in the portfolio. We've had a few new analysts come into the business, and we really wanted to take them over some of the successes and failures and see whether we could put things into the buckets. I think it was really useful for some of the young analysts in the team. I think it was also very useful for some of the older analysts in the team to really have that holistic view at what we think has been successful for us and what hasn't. Obviously, every time something like a Technicolor doesn't work, we go back and do an analysis of the mistakes we made and see what needs to be improved there. This was more a whole of portfolio exercise. If we look at all of the big winners and losers, are there any buckets that we can put them into? In Gareth's presentation, he's going to talk about idea generation and the two different buckets from where we make money. I've quickly categorized them here into psychological advantage and informational advantage. So the left-hand bucket is really buying from people who are panic selling or selling irrationally, and the right-hand bucket is where we've been able to understand something about a business that other investors didn't understand. So we weren't necessarily buying it from someone who was behaving irrationally. We were buying it from someone who knew less than us. And the exercise was to go back over the past 9 years of investments and see which of those two buckets for us were successful and which weren't. This is a non-scientific representation of the winners. The size of the bubble is the size of the win, and the axes there are psychological advantage and informational edge. So we've just tried to put some of our successes onto this chart and say, well, were we investing in something where we just had a psychological edge? Was it just an informational edge, or did we combine the two? Now, Lotto24 is a really good example of a business where we think we had pure informational edge. It wasn't panic selling at the time. It was a fairly recent IPO when we came across it, but we knew a lot more about this business than the local investors at that point in time. We've owned Jumbo Interactive here in Australia for a number of years prior to even coming across Lotto24. And in fact, it was through Jumbo Interactive that we found out about this company. Jumbo is an online retailer of lottery tickets here in Australia. It's the largest independent player in that market, and it sells Tats's lottery tickets through its website. We'd seen that business grow from small to large. We could see how much cash flow it was throwing off. And when they were planning an expansion into Germany, we met with the CEO who was in the office and said to us, we're trying to be number 2 or 3 in Germany. We can't be number 1 because there's a company over there called Lotto24 that we know is going to win. We think we can have a successful business as number 2 or 3. That was very interesting because Lotto24 happened to be listed on the stock market, and it was trading at a price that we didn't think reflected the potential for it to be number 1 in that market. They were signing up 300,000 customers a year at that point in time, but it was fairly early stages for the company. And the insight into this business model was that the customer acquisition costs are quite high. In Lotto24's case, they're spending 25 euros to acquire a customer. That customer generates about 120 euros worth of value over its life. So that's pretty good business. You spend 25 to acquire them, they generate 120 of value. You would sign as many of those customers up as you could. But what was happening on the accounting statements was they were expensing those acquisition costs up front, and they weren't generating the revenue for years down the track. So the more customers they signed up, the more money they lost from the accounting statements perspective in the short term. And that's what was scaring investors in Germany. We had seen that business model evolve here in Australia. We'd seen Jumbo go from a similar position to generating lots of cash flow, and it was pretty easy for us to model out how that was going to happen in Germany. It's a really good example of a business where it's informational edge that has created the opportunity for us. South32, just really quickly, it's a mining business. We are not mining experts. We didn't make money there because we know more about those mines than the analysts who cover it. We made money there because it was distressed selling at that point in time. And Gareth's going to touch quite a bit on this bucket in his presentation. You can see a pretty good spread there, and that's the message out of this chart. Yes, we've made some money out of psychological advantage, we've made some money out of informational edge, and we've made money out of a combination of the two. The thing that really hit home for me was that if we put our losses on the same sort of axes, and that's what this is, we've got more of a cluster towards the psychological advantage side of things. So yes, we've made money out of businesses like South32. We've also lost a lot of money out of businesses like Enero and Dolphin Geophysical, which was another seismic investment that we made in the international fund. Both of those situations were wading into distress, and it turned out in hindsight that the distress and the panic was justified. And this has really made us have a long, hard think about where our money is made and how we take advantage of that psychological edge that we have. I think it's a key feature of our business, a key competitive advantage that we have, that we can and do invest in these distressed situations. But we've made our money out of a combination of distress, but also informational advantage. And it's just taking that extra step to make sure we've done the work, to make sure we've got the information that we need, and to make sure that the panic is not justified. And if we looked at those huge winners, it's not necessarily businesses like Boom. Boom has been a good investment for us. We bought it at a massive discount to its NTA. We will sell it at close to its NTA, and we'll make money doing that. But we've also had losses in those pure asset plays. Where we've made lots of money is where we've bought a business that was perceived as distressed, but where it turned around, the earnings recovered, the business recovered, and the perception changed as well. So you go from a very low multiple of low earnings potentially to a much higher multiple of high earnings. And that's where we've made 4, 5, and 6 times our money. And you're going to see a lot more concentration in the portfolios into these, particularly in the international fund, into these types of opportunities. We've been making that progress for most of the past 5 years, really, but you'll see a lot of opportunities in the portfolio at the moment where we think they're a combination of focusing on areas of dysfunction and areas of panic, but also making sure we've got the informational edge. Gareth's going to talk about airports in his presentation. It's a great example of an asset class that we know at least as well, if not better, than other people. He's also talking about an individual stock, Blancco Technologies, and one of the largest holdings in our international fund is a stock called Gulf Marine Services. Our Vise Pegion presented on this at Sydney and Melbourne webinars. We don't have time for him to do that today, but it's a really, really interesting business that's currently trading at a big discount to its net assets. It's in the oil and gas services space. It's listed in London, where most of its competitors are listed either in the Middle East or in Norway, so it's not widely covered. And historically, this business has earned quite good returns on its capital. We think there's the potential for it to at least be worth its assets, but also be worth a significant premium to that when it's valued based on earnings. All of this reflection on the past has also tied in with Gareth, our senior analyst on the international fund, moving his family back to Sydney. We've been sitting in one office now for almost 9 months, and analysing the stocks that have worked for us and haven't worked for us in the past has really made us think about that business model as well. Our insight is that we haven't had a huge amount of advantage from having boots on the ground in some of those foreign countries. our biggest and best ideas have been when we've been working together on things where we have some advantage that we know often comes from our Australian experience or from our personal experiences elsewhere. It's not a sitting on the ground reading local newspapers. It's all about focusing our team skills on those areas where we think we have an edge. And you'll see in the portfolio at the moment, we are highly concentrated on places and ideas where we think we've got some advantage. That's oil and gas services at the moment, and it's also in the UK. So it's an important point for anyone invested or considering an investment in the portfolio. We are not going to run a portfolio that's one stock in the US, one stock in Europe, one stock in Asia. You're going to get a concentration either in areas of distress or in areas of our expertise. We've had a lot of questions as we've travelled around about outlook for the year and years ahead. The answer, as per usual from me, is that I don't know. There are lots of things to worry about out there at the moment. We've just put a selection of headlines up on the screen here. You've got Brexit, you've got a lot of housing debt here in Australia, you've got the potential for a trade war. Most worrying probably for Australian investors, you've got a very wobbly housing market here. And most worrying, and for us at least, is that equity prices around the world are generally expensive. That makes it hard to find the type of high return opportunities that we're normally looking for. Our philosophy always at Forager is to protect, not predict. And that means thinking about all of these potential risks, thinking about everything that could go wrong, and making sure that the portfolio is robust to any one of these events. In the Australian fund, we've done a quite deep exercise on housing risks to the portfolio. It won't surprise you if you know my views over the years. We've tried to avoid significant exposure to it. But when this type of thing happens, you need to think about second and third order effects. So discretionary spending. One area that we do have exposure to that we're thinking about is just general availability of credit. If the banks here get into trouble, it may affect industries that are not even housing related if the banks are in trouble with their own balance sheets. So there's lots of things to worry about, but having a portfolio that is well protected against a variety of risks is the most important thing. In fact, at our Sydney seminar, Gareth pointed out that we actually need, in terms of opportunity, you need things going wrong. You don't get a combination of no concerns about what's happening in the world and very, very cheap share prices. We would welcome a bit more turmoil in terms of putting that cash to work that we have in the portfolios. This is the top 10 holdings in the Australian fund at the moment. A couple of important points from me. Alex is going to touch on some of the new opportunities there. You've got a few stocks at the top, particularly McMahon and iSelect, that are going to have a significant impact on returns over the next few years. Keep an eye on their results as they come out. We've got minimal exposure to Australian housing or consumer spending in the portfolio. Oil and gas services is a sector that I'm particularly optimistic about at the moment. I think you've seen a recovery in the supply and demand dynamics there that has been reflected in the oil price. It's not yet reflected in all of the oil services companies' share prices. In this portfolio, we own Matrix, Composites and Engineering, and MRM. The cash weighting is still 23% in the portfolio. There's still a few stocks that we're in the process of selling, so it's as likely to go up as go down, but we also have a long list of potential investments that we're just waiting for the right price for. The international fund, 5 of the largest 6 investments here are listed in the UK. I really want to emphasize and underline that word listed. It's one of the main reasons we're finding opportunities there at the moment is that all stocks are being thrown out, whether they're exposed to the UK economy or not. Our top 2 holdings, Just Group and Auto Trader, they are both domestic businesses, but we think they're both quite resilient. Then going down the list, we've got Blancco. Gareth will talk about it, but more than 90% of its revenue is not in the UK. Gulf Marine Services is 100% non-UK, and Babcock International has a significant percentage of its revenue offshore as well. So they're just good examples of businesses where distressed selling is, or people taking their money out of the whole market is creating opportunities for us to invest without necessarily taking on a huge amount of Brexit risk. There's minimal remaining exposure to mega caps in the portfolio. We have been transitioning over most of the past 5 years. The one that sticks out like a sore thumb there is Alphabet. if we can find more attractive small cap opportunities, Alphabet will go as well. But we think as a parking place for money, it is a wonderful business that has some very good growth ahead of it, and it's not trading at a crazy price. So you should view it as an outstanding parking place. And oil services exposure, it's almost the same in this portfolio at about 10%, with Gulf Marine Services being the most important there, and PGS that I touched on earlier still in the portfolio. So that's it for my reflection on the past year. I'm going to bring Gareth into the presentation now, and he's going to talk about how we find new investments, and particularly a couple of those new ones. Welcome, Gareth.
Thanks, Steve. Good afternoon to most of you, and good morning if you're out on the West Coast. Over the next 25 or 30 minutes, Alex and I are going to be talking about new ideas. Now, idea generation is the single most important task our team confront when they come to work each day. We run a concentrated portfolio. We need to know the stocks that we own very well, but finding that 500th fact on a company that we own and know is far less likely to be impactful to portfolio returns than finding a compelling new buy idea. I ask you to think of it as akin to managing a conveyor belt. New ideas come onto the conveyor belt, and as they mature, they move along. Now, ideas mature for a variety of reasons. Sometimes everything goes exactly to plan and we make the money that we hope to make. Other times there are changing circumstances, new competitive threats, and sometimes our thesis was just plain wrong. In short, though, they come off the conveyor belt because they failed to meet our minimum return hurdle. So there's already a natural need to replace ideas on the conveyor belt, but that's actually not where the real power lies in this concept. Idea generation is about consciously speeding up the conveyor belt. Why settle for a 10% return from something that we own when we can find something else that's likely to generate us 15% or more? So there's a constant process here to make sure that we've got the best ideas in the portfolio. We always need to be looking for new ideas, and we need to be looking in the right places and with the right mentality. We're often asked, how do you expect to compete against larger and better resourced outfits all around the world? There's no doubt it's a tough hurdle. I could talk to you about our idea generation process. I could talk you through some of the hows, how we run filters on Bloomberg, how we read endlessly, annual reports, trade journals, 13F disclosures, substantial shareholder notices. I could talk about how that we travel and observe and experience. I could talk about how we attend conferences and we meet management teams and visit factories and headquarters. We could talk about how we meet brokers, how we develop expertise and experience, and how we model and pontificate and test and revise. But little of that's what makes us truly different. In fact, we don't have the resources to win an arms race here. What we do have is a very effective way to whittle the universe of opportunity down to a much more manageable list. And that's through a laser focus on the question, why? Why might this stock be cheap? In fact, we think that leaving this part till the end of your investment process is to put the cart before the horse. For us, it's the why that dictates the hows and the wheres and the whats and the whens of our idea generation process. As Steve touched on earlier, there are really only two buckets from which to find screamingly cheap opportunities. First here is irrational selling. This comes under numerous guises: fearful selling, forced selling. Broadly, what we're looking for is an incorrect consensus to take advantage of. A classic example here that Steve touched on earlier was South 32, which ended up in both our funds. Now, we don't know more about some high-quality manganese mine on an island off the Northern Territory than an analyst at, say, UBS that spends hours on this every week. But what we do know is what irrational selling of a spin-off looks like. The share prices are down a long way. The large funds that held BHP are unable to continue holding, and you can see that in the substantial shareholder notices that were being lodged daily. There was a general pessimism around the industry at the time that was coming specifically from China. We know how to wade in at the time that no one else seems to even want to talk to that analyst. Another example that we've put up here, perhaps prematurely, is Just Group. I say prematurely because we haven't made any money out of it yet. But we've been buying that basically in the aftermath of Brexit, when private equity shareholders have been selling down and out. The other important edge for us is informational. And this is, as Steve touched on, this is becoming increasingly important. We know something that others don't. We're not generally trying to go out and develop a whole range of new expertises, but rather take the expertise that we have and cast a wider net with it. In the case of our international fund, globally. The classic example for us here, again, is airports. Steve in particular had the early knowledge on the wonderful economics of airports. He was involved in the Macquarie Bank bid team for Sydney Airport. It's a concept that we understand the wonderful economics of it. We understand where investors tend to get it wrong. And it's an idea that we've parlayed into 3 great investments over the years. The Sydney Airport, which has been in the Australian fund. In 2013, we bought and held Zurich for a couple of years. And more recently, we bought Vienna Airport, and it's been in the portfolio for a couple of years as well. And we still hold that. And the other idea, again, that Steve's covered already is Lotto reseller Lotto 24. Again, it was an irrational selling opportunity in the Australian fund, Jumbo Interactive, that gave us the knowledge to be able to replicate and develop an informational edge in Germany and have an understanding about that business that the local investors didn't have. Now, informational edges don't need to be industry specific. They can be geographic. They can be an accounting-based quirk. They can be a unique insight into the economics of a business. It seems to us that most value investors are trying to research and value a very large list of stocks, looking for potential opportunity. We start by looking for those pockets of distress or misunderstanding, and only when we feel we have a clear grasp of where it is that our edge might be will we dig deeper. Now I'm going to talk to you about a couple of ideas in the international fund so you can see how that philosophy works in practice. The first is very much from the irrational selling bucket. September last year, Steve and I were sitting in a broker meeting in London, and we'd been there for an hour already. We'd heard a dozen excitable stock pitches, none of them up our alley. Our jackets were already on. We were ready to leave for our next appointment. You got anything else? Anything hairy? The broker's response was sheepish. Well, there's this one business I really like. It's actually a very good business, but we've had to cease coverage recently. It's called Blancco. The managing director was recently fired. It looks like there was some major impropriety there. They haven't been able to publish their financial statements on time, and they're going to have to go back and restate last year's revenues and profits. It turns out they were booking some revenue on a very large contract that never actually materialized. Oh, and the stock's down about 80% in the past few months, and we had a buy recommendation on the stock at that high price. Now, that's a potential why for us. Here's something worth pursuing. We can see why the rest of the world might get something like this very wrong. More work is definitely warranted. So what did our research reveal about the company? There's 2 parts to Blancco, and the one that most immediately grabbed us is called data erasure, and it's the most important part of the business. Think of a piece of IT hardware, your computer, your mobile phone, or a server or tablet. When that equipment comes to the end of its useful life, you're going to need to clear the hard drive for obvious security reasons. There's really 3 main options to clear that hard drive. You can physically destroy it, whack it with a hammer, for example. You can't reuse it then, and recycling is also difficult. You can scrub or overwrite that hard disk. Now, we say scrub, but my understanding is it's much more akin to a scramble of the information on the hard drive. You do that process once, and you're still quite vulnerable to the efforts of a talented hacker. Corporates typically override 3 or more times, and we understand the US Department of Defense has an 8-time overwrite standard. The third option to clean your hard drive is to use a piece of software to clear it. It goes through and systematically clears every single spot on the hard drive. Now, if you opt for that option 3, Blancco is the gold standard. There are free alternatives available online, but in the paid Eurasia market, Blancco has a more than 80% market share globally. It also has received certification from dozens of regulatory organisations around the world to say that it's a process that works, and it can actually provide an audit trail for customers to prove that your hard disk has been cleared properly. I don't really need to tell you how important this is becoming with the proliferation of IT devices and the risk of sensitive data loss. The two main types of customers here being large corporations and specialised IT asset disposal firms that do the work on behalf of large corporations. The revenue is typically volume-based. The customer comes, they buy a license that might allow them to wipe X devices over the next few months. And then a few months later, they're back buying more licenses. So there's lots of recurring revenue, and we have a highly loyal customer base with retention rates north of 90%. The second part of the business is a mobile part of the business. It's called diagnostics. It took us quite a while to come around to this side of the business, but it's increasingly obvious to us that diagnostics and Eurasia can belong together. Let's say you wake up one morning and your phone is not working properly. So you walk into a telco store and the attendant plugs that phone into a diagnostics unit. Now, most of the time, the problem is solvable, and most of the time, I hate to break it to you, the problem is your fault. Typically, you forgot an important update. The diagnostics unit helps the attendant to identify the problem with your phone and solve it, and you're off and on your way. Sometimes, however, the problem's beyond repair. That's no worries, you're already installed today. I'll sell you a new phone. We can transfer the old data and the apps from the old phone onto the new phone via this diagnostics unit. And we can offer you a trade-in on your old phone, and we'll clear it with Blancco Eurasia so you know you're safe. It sounds like a pretty good offering. Well, Blancco has this up and running in a couple of thousand stores in the US through one of the big mobile networks. And it's running about 100,000 such diagnostics tests every week. We think there's a lot of upside here with other telcos able to use that product. So where do we stand at this stage? Well, we have a product here that's a global leader, tick. Recurring revenue, we like that, that's a tick. Large addressable market, that's a very big tick. It's an obvious product need out there. Is it a repairable situation? At this stage of our research, the answer was a tentative tick. The next step was to talk to the founder of the Eurasia software and learn more about the scope of the opportunity, and in particular to size up the problems that the company was experiencing in 2017. He's on the finish version of Shark Tank if you ever happen to be stuck in Helsinki. And the next we talked to a national sales manager. We asked how do you generate sales leads? She told us they do not generate sales leads. Customers just ring them up. She told us that they do not have enough staff to deal with the level of inbound calls from customers, let alone actually making outbound calls. That sounds to us a lot like a solvable sales problem. Now, we prefer sales problems over most kinds of problems. They're solvable and they're issues worth solving. So all our channel checks suggested this was a company still growing rapidly, although not as quickly as that former managing director had claimed. We think it has a long runway ahead of it. And to top it off, a few months ago, the company appointed a new CEO, Matt Jones. He's a Silicon Valley IT executive with a good pedigree and has been involved in several somewhat similar software businesses over the last 20 years, growing revenue manyfold and then typically taking them to a sale to a bigger IT or software firm. And we think that's quite likely to be the future here for Blancco. We started buying Blancco shares last year when they were below 50p. It's up more than 50% on our initial purchase price, but we have still been buying more stock fairly recently. The opportunity here is big. The revenue is growing fast. We think this is a business that can and should earn profit margins north of 20%. Typically, a business like this might trade at 5 times revenue or more, and our average purchase price here is well below 2 times revenue. So there's a lot of potential upside in this irrational selling opportunity. Next, I'm going to move on to a very different kind of idea. I'm going to talk to you about Bonheur, which is a Norwegian conglomerate that's been in the portfolio for about a year. Now, there are a lot of large family-controlled conglomerates in Europe, and they often trade at large discounts to net asset value, and often for good reason. That reason is typically the family doesn't really care about minority shareholders, and maximising your returns is a long way down the list of their priorities. We got this idea sitting in a conference in Spain early in 2017. A Norwegian fund manager was presenting his favourite idea, and it's called Bonheur. And he went on to outline why he thought the stock was worth twice the then share price. Now, this is a business with roots in shipping and offshore oil services. Both of those sectors are down in the dumps to this day, but they were really down in the dumps 18 months ago. And we think that was probably reflecting on the Bonheur share price. And while this business has that sort of historical roots and is listed in Norway, the main value of its portfolio now is in onshore wind farms in the UK. The point that really caught our attention was that the fund manager told us about how Bonheur dramatically improved their disclosures. Prior to the end of 2016, they used to consolidate their two segments that held wind farms. One of those was a division with a portfolio of wind farms that they owned 51% of, and another one that they owned 100% of. They consolidated those together and reported a fairly modest amount of debt. The new disclosure revealed that the 51% owned subsidiary was swimming in debt, and the 100% owned subsidiary that was really, really rich in cash. Now, that's a potential why for us. This is a business that had a bunch of cash that was quite possibly missed by the broader market. And it was quite possibly missed because that wasn't a fact that was even disclosed to the market a few months earlier. It owned wind farms. We know the asset, we like the economics, particularly in the UK where there's been a very generous renewable regime. And this is a business that had big helpings of limited recourse debt. We've dealt with that before. We understand how it works. And we also understand that investors often get it quite wrong. So this is an area we might be able to develop an edge. It's time to get to work. We did a lot more digging. The most important point for this webinar is what we turned up, and that was another source of potential hidden value. The company was halfway through constructing a new wind farm in Scotland. Now, as I touched on earlier, the UK renewables regime has been very, very generous to developers of wind farms, but that regime had recently changed. What was important here is that Bonheur's new wind farm snuck in under the old regime, and that gave us a high degree of confidence that by the time the turbines started turning later in 2017, this is an asset that would be worth at least 2 and quite possibly 3 times, worth 3 times more than what Bonheur invested in it. Now, that ultimately proved the case when the company sold a 49% stake in this wind farm just a few months ago. We bought our stake in Bonheur about 12 months ago. It's up nearly 40% still, but we still think it's cheap. So let's do a quick sum of the parts run through. There's almost 50 Norwegian krones or NOK per share sitting in the bank. Just to put that into perspective, that's more than 40% of Bonheur's current market capitalization and about 60% of the purchase price that we paid 12 months ago. There's a 51% remaining stake in that new farm, and we have the recent transaction to help us peg the valuation. There's a 51% stake in another larger portfolio of older Scottish wind farms. Older wind farms are not worth as much as new wind farms, and this division also has the significant helpings of debt that we touched on earlier. Our value here is net of that debt. There's 2 more wind farms in Scandinavia, and this division also has a large pile of cash. And then there's 4 older cruise ships playing the high seas with paying customers. And then there's an offshore wind business that provides installation services for these giant turbines that you see offshore. The main asset here being 2 massive jack-up vessels. There's a bit more here, there, and elsewhere, and then we need to deduct a few items. The 2 most important ones being an underfunded pension liabilities and capitalised corporate costs, as this is an externally managed vehicle. Here I provided a ridiculously simplified estimate here, a ridiculously precise estimate, I should say, 167 NOK per share. You can think of that as a best guess. Internally, we don't do it this way. We think of these things as some of the parts analysis. We think of it as a range of possibilities. And it's pretty hard to arrive at any scenario that sees us losing a lot of money from today's price. On average, we think there's at least 50% more upside, and that's an average case rather than the best case. That's it from me. I'm going to pass you over to Alex Shevelev. Chev might be a new face to some of you, but his old hat around the Forager offices. He's been working for 12 months, more than 12 months now, and he's had a very significant impact on the makeup of the Australian fund, helping to speed up the conveyor belt with some important new ideas. He's going to outline a few of those for you today. Thanks for your time.
So thanks for that, Gareth. My name is Alex Shevelev, and I'm a senior analyst working on the Australian Shares Fund. So earnings guidance slashed by 64%. The CEO gone, the stock down 54%. That was the situation for online comparator iSelect, the ticker is ISU, when we started buying that stock in April. Now, the company's had a bit of a love-hate relationship with the market, and that's been for good reason. It should be a growing new age online business, but it's disappointed in nearly every year since its 2013 IPO. First, we had an ASIC probe around the IPO disclosure. Then in 2014, a write-down of some assets, a failure of an insurer that iSelect was associated with the following year, a major downgrade in 2016. Now, 2017 was a rare respite, and the stock went up to $2.20. The founder took the opportunity to sell his stake in the business, and investors in iSelect should have followed suit. Now, in April 2018, there was another big downgrade. The stock closed the day of that downgrade at 45 cents. This was a hated stock, and it was a frightening investment proposition. So we sprung into action. So we've had quite a lot of people as we've been touring around the country. We've spoken to people about their experiences with health insurance. And one of the things to note, it's quite a difficult, complicated process. So iSelect helps to guide clients first online and then over the phone to a policy that gives them better cover at lower cost. And it compares other products as well. Think about electricity, think about broadband and life insurance. iSelect then gets paid for the referral by the product provider themselves. Now, this does produce some conflicts. We were looking at this stock as it fell from $2.20 to $1, and the fund had owned a small position once before, back in its previous moment of difficulty, but we couldn't quite get there on valuation. It just wasn't cheap enough. Now, a little aside, we're usually quite skeptical of management guidance, and this was really a company that should not have been guiding. So almost all the profit of this business is expected in the second half. We're talking about March, when shoppers compare policies as premiums go up, and in June, when you start thinking about the new financial year. The company had guided for $26 to $29 million of earnings before interest and tax. That was slashed to $8 to $12 million, quicker than you can say failed marketing campaign. Now, after the downgrade at 45 cents, the situation had changed a lot, and here's why. So we look at this business as a combination of the past and the future. So some insurers, they prefer to pay iSelect upfront. Others prefer to pay over time as the client remains with the insurer. Now, we've seen these sort of situations before. Freedom Insurance, which is another investment in the Australian fund, has similar features. It collects cash from distributing funeral insurance. These are easy to miss because earnings are reported up front, but the cash can sometimes trail by many years. So in the case of iSelect, the past is worth about 58 cents. Now this is cash on the balance sheet currently, cash to be received from past policies sold, and a small investment in a similar business offshore. Now when we were buying in April, we were paying less than just this past value, with no value at all for the future. So what is the future here? So firstly, we think the business has a place in the world. It's got high market share in new health insurance policies. That is about 15% of new policies flow through iSelect. It's got brand recognition, and it's got customers who find them convenient and quite easy to use. And they've also got, importantly, a place in the marketing budgets of health insurers, especially those that are trying to make ground on the industry behemoths like Medibank and Bupa. Comparators are a marketing channel for these challenger brands, and they're a cost-effective way of getting new policyholders on board. Now, a challenger brand, you're thinking someone like an NIB would use iSelect to improve the number of policies that they're taking on in any year. So iSelect in this comparator channel is actually the largest business. It makes up about 2/3 of comparators. So we spoke to people inside the business, both past and present. We spoke to competitors and we spoke to the health insurers themselves. And of course, went on and compared some policies. So I'm now paying a lot less for my electricity than I was before, which is quite handy. Now, disappointments aside, this business has earned an average of $10 million, excluding those historical cash flows per year since listing. And we think the current profitability problems are actually fixable. The current downgrade was brought about when a TV campaign, for which iSelect had quite high expectations, failed to deliver. They spent an extra $10 million on TV to counteract the increasing cost of paid digital marketing through everybody's favorite search engine. Now, at about 35% of revenue, marketing is a big cost to the business and brings in leads that will later need to be converted into clients. Now, one misstep on this marketing spend can mean disaster. And so it was. I'm not sure if anyone saw the campaign, but it was bland and it really didn't attract that many new customers to the site. But this is fixable. So that spend needs to be cut or it needs to be redirected to where it will actually attract customers. And once they're in, iSelect will need to convert those leads into clients more effectively and at lower cost. So that might mean selling cheaper products where they earn a lower commission without a phone call or with some contact from their cheaper South African call center operation. That value, the future value here, gives another 55 odd cents for a total of about $1.13. Now, as Gareth mentioned, these numbers are not exact, of course. This is a best guess from a range of potential outcomes that we look at. But it is a stock that investors can get quite excited about. It's really not that hard to make a case for a valuation substantially above this. So where are we now? Well, we didn't expect anything too quickly. There are problems to fix, and that will take time. But things heated up quite quickly. So compare the market. You may have seen their Meerkat ads on TV is iSelect's largest competitor. And it's owned by a large, well-funded offshore group. They saw the same value that we did in iSelect and bid off a 20% chunk of the company. Putting these two businesses together could lead to plenty of cost savings and a more powerful industry position. If they want our 9% of iSelect, though, they'll really have to pay up. And now for something completely different, from online to on the high seas. This is the MMA Prestige. It is 88 meters long, can carry 2,700 tons, including 100 crew in comfortable quarters like this, and with onboard facilities like these. So complex computer systems on board this vessel work the thrusters, and that means the Prestige can operate just a few meters away from a football field-sized oil and gas platform, even in dreadful weather. That crane on the back can lift 100 tons, and yes, that is a helipad. It's an impressive vessel. So why is this impressive vessel of interest to the Forager investment team? Well, it belongs to MMA Offshore. The ticker is MRM, an investment in the Australian fund. Now, unfortunately for shareholders in MMA, the seas haven't really looked like they do in the back of that picture. They've looked a lot more like this. I'd say that sums up the situation quite well. In 2014, the stock was flying high. It had $800 million in market capitalization. Then the oil price halved as the US shale boom produced more oil at lower prices. Spend on offshore oil and gas fields cratered as oil and gas companies cut back their spending, uncertain about the future. And vessels were left to sit idle or to agree to work for rates that were half of what they were getting just a few short years earlier, barely covering crew expenses. By June 2017, MMA's market capitalization was down to $60 million, with a whopping $295 million of net debt. So here was our chance. We participated in a $97 million capital raising that bailed MMA out from their short-term debt issues, and in that process paid only about 50 cents on the dollar for MMA's modern high-spec fleet. Now, this is an asset-heavy business. It's in a difficult environment. It's got an uncertain future. In many ways, it's a classic Forager investment. Now, MMA owns and operates vessels like the Prestige for oil and gas companies around the world. So from Australia to the Middle East to Africa, MMA's vessels are helping clients supply, build, and maintain offshore oil and gas facilities. Investing in MMA now is a combination of supply, of demand, and of time. So first, the supply of the sorts of vessels that MMA owns. Conditions in 2014 seemed sunny. And so MMA, along with their offshore peers, spent on new vessels, and plenty of them. Now, after the spend on offshore development died down, there were simply too many vessels. And building these long-term assets really means making a call on offshore activity for a good amount of their 25-year life. Getting that call wrong has meant a massive amount of value destruction for MMA shareholders. The company's current fleet is valued at about $500 million. It cost nearly $1 billion to build. Now, this is something the mining services players of Australia would be very familiar with. They went through something similar post the mining boom, and we owned many of them during their difficulties as well. But let's look forwards and not backwards. So orders in the last few years were zero. Thankfully, no one's been crazy enough to build new vessels when there are so many still floating around. And the current fleet is aging. So vessels are slowly being destroyed, especially those that are over 25 years in age. Those that have been out of the game may have been out of the game too long to return. Oil and gas producers don't want vessels that have been laid up for years working on their precious projects. Now, of the 3,500 vessels that are out there, it's likely that only about 2,500 will ever be able to come back to work. So that's good, but a recovery in demand would be even better. So offshore oil production is about 30% of total oil production. We think it's here to stay, and demand overall for oil is rising. A mature field produces 5% fewer barrels each year, and that needs to be replaced just for the amount of production to stand still. The oil price is already up 60% odd higher than in June last year. So what MMA needs now is for offshore producers to start spending again. And they need to feel comfortable with the oil price to pull the trigger on sometimes multi-billion-dollar investments. Now, when they start spending again, vessels will first go back to work, and then the price for a day of that vessel's work will also start to rise. As we know from our experience in mining services, this work can come all at once, but it might take time, and we are prepared to wait. That brings us to our last key element, time. So MRM is still carrying debt, and plenty of it. and net debt is about $190 million. When we invested to recapitalize the business, one of our key requirements was that the banks give MRM plenty of time. We didn't want them pulling the rug from under the business just as things were improving. So the banks stepped up. Debt is now not due till 2021 and covenants are reasonable. This gives time for conditions and profits to improve. So where are we now? Well, we're waiting. The stock is 25 or more now % higher than our entry price, but at 25 odd cents represented another 50% to go until the fair value of the current value of the vessels is implied in the share price. Now, as with mining services companies, that might not be where it stops. Many are now trading above the value of their assets as investors instead start to focus on earnings. So far from sinking, we think MRM has some way to float yet. I'll touch briefly now on the Australian portfolio and how it's positioned going into the following year. So much of the performance investors have seen over the last few years have come from investments made in 2014 or earlier. So these are stocks you may have heard quite a bit about: Jumbo, ServiceStream. We've been exiting these investments over the last year. We've also been busy adding new stocks to the portfolio, ones we hope will drive performance over the next few years. So of our top 5 positions, 3 are ones we did not own a year ago, and we're working to add more. Our stock watch list is full of opportunity. We've done some work on these potential new investments, but we're waiting for lower prices and a margin of safety. And as some recent downgrades have shown, it doesn't necessarily take a market correction to set up some exciting opportunities. Now I'll hand over to CEO Jeff Wheaton. I'll hand back to Nicole.
Great, thanks, Alex. It's now time for the question and answer session. We already have a few questions in the queue, but you can still enter new ones if you have anything you would like answered. Our first question is from William, and it is: do you believe Isolex can be as successful in other industry verticals as it is in health insurance?
So in short, it's Alex here. In short, no. And part of the reason there is because the health insurance vertical has quite a high value to the sale. And so Isolect actually ends up keeping quite about $1,000 odd per sale that they make. That's a relatively large number, and it's really hard to replicate that large number with some of the other verticals that they're operating in. The second aspect to that is there are some verticals that are more complicated than others. So the health insurance vertical is quite complicated, and having someone over the phone talk you through those issues is quite a good thing. For something simpler like broadband, you might not need someone over the phone. You might be happy to just browse around the internet or and not speak to anyone about that.
Our next question is from Bo, and it is: I was just wondering what value you see in MSL Solutions. I notice you are a significant shareholder. Given they are software as a service, does it not tend to go against Forager's anti-theme investing?
I'll take that one, Bo. It's Steve here. Look, I wouldn't say we've got anything against software as a service businesses at all. In fact, I'd say it's a very attractive business model if you can find the right business, and one that we are prepared to pay a premium for. The issue with us is that we want to buy stocks cheaply. So there's nothing at all wrong with software as a service. It just tends to be the case that they trade at premium prices, and therefore we can't make the risk-reward trade-off stack up. MSL is a fairly recent IPO. It's a business that does software for clubs for the most part, particularly in the golfing industry. It's not as software as a service as we would like, to be frank with you, because a lot of their work is actually implementation, and it's been a higher percentage than their original documents suggested. It's also a business that we are having some frustrations with. We think there's a very attractive growth path ahead of them. This is core software, so once you implement it for a customer, it tends to be very difficult for them to switch. The language around their reporting, though, has been very poor. They are reporting adjusted EBITDA numbers that take all of the negative things out and include all of the positive things. So it's a work in progress is probably the best way of putting it.
Our next question is from Gabby. Are some views suggesting the markets are close to the top and due for a correction? Do you have any thoughts on this? And do you use any hedging strategies?
Hi, Gabby. It's Steve again. I've been hearing the market's at its top for most of the past 5 or 6 years now, and people have been very nervous about it, really, ever since the financial crisis. So I think you can do as much damage to your portfolio by panicking about markets being at their tops than you do by being overly exuberant at the same time. So we're constantly just trying to balance the opportunities that are available to us. We are not hedging other than holding elevated levels of cash, more so in the Australian fund now than the international fund. And we tend to get our returns from company-specific events rather than overall market movements. And you should really think about that if you're contemplating investing with us. The returns, someone used the word idiosyncratic a couple of weeks ago. I think it's a nice way of putting it, but stock-specific is an even better way of putting it. I think if a stock like Blancco can deliver the business performance that we expect it to, then whether the market goes up, down, or sideways, you're going to see a healthy appreciation in the share price. And even if you don't, as long as the business keeps growing and is profitable over time, then we're going to be happy owning it.
Our next question is from Anne. iSelect in health fund comparison is a poor comparator because NIB appears to be the major fund it promotes. iSelect does not provide wide comparison of the majority of health funds. It deserves to be marked down.
Hi, Anne. It's Alex here. Thanks for the question. It does, and this is an issue across the comparator space. They do not compare all policies. So NIB is on there and a whole host of other smaller players. The only brand from the major players you'll see there is AHM from Medibank. Now, it is a common comparator problem, and someone like Compare the Market has similar issues. In fact, they do carry some range of the Bupa policies, but then they also are not exactly independent because they've got they carry a lot of the policies that their parent also a lot of the policies issued by a company their parent also has a stake in. So we're aware that that is a risk and a complaint, but we still think, despite that it offers some value to people using it, and it offers some value to their health insurance and other provider clients.
Our next question is from Brian. While appreciating your high conviction, deep value approach, when looking at your complete portfolio, do you apply any top-down filters, industry, company, size, country, in managing risk?
I might let Gareth take that one. He's just going to walk over.
Look, we don't source ideas that way, but we definitely think of risk management along those lines. So we spend a lot of time trying to understand the obvious correlations in our portfolio. For example, we're happy to own 5 of our top 6 positions in the UK, specifically because 3 of them have not so much exposure or no exposure to the UK consumer. So for us, the risk there that we need to look at is exposure to the UK consumer, and another risk might be direct exposure to Brexit. We think about how all these things fit together in our portfolio and spend a lot of time on that. So we don't ignore it. We just want to make sure that we take risks that are A, manageable, and B, that we're getting well rewarded in terms of potential returns. Anything to add, Steve?
No, perfect.
Our next question is from Jock. Can you give some feel for the relative upside or value you see in the international fund at present, i.e. even with stretched valuations, how is the actual fund valuation?
Thanks, Jock. It's a good question. It's Steve back here again. Look, we are pretty optimistic at the moment about the fund, and I'd say the number one thing for you to watch when you're trying to answer that question yourself is our cash levels. I said earlier, 10 to 20% is perfectly normal for us, and that cash level at the moment is 12 to 13%. So that's a good sign that we're finding plenty of opportunities. The UK is particularly prospective at the moment, and as I said earlier, we're finding opportunities to invest there without taking on the risk of Brexit, but getting the commensurate potential returns that come with that market being very unloved. Emerging markets as well have been absolutely smashed, both currency-wise and stock prices over the past 12 months. We haven't done much there yet, but we're pretty optimistic about some of the opportunities that we're coming across, particularly at the better quality end of the spectrum. So I think overall valuations are elevated, and particularly in the US, it's very difficult to find cheap stocks, but there are pockets around the world at the moment, and thankfully they're pockets that fit within our circle of competence that are providing some good value. Sorry, that was half a sneeze.
Our next question is from Brian. Given your cash levels, how would you describe the current level of opportunities available and their relative attractiveness compared to what the fund has seen since inception?
Thanks, Brian. That's quite a similar question to the previous one, I guess, and I think you can. We would like to be finding more opportunities in the Australian fund, that's for sure. I think the difference between this market and what we've seen historically, it's not, if you look at the overall metrics, the Aussie market's not trading at crazily expensive valuation metrics relative to history. The problem at the moment here is that we're not seeing the diversity of valuation that we have seen historically. So you wouldn't pick a sector at the moment and say it's particularly unloved. We have seen the stocks that go from darling status to not being darlings anymore. We've seen the market punishing them very hard. It's how iSelect's turned up on our radar. We've had a good look at Retail Food Group, at Accenture, at a lot of these businesses that are heavily sold off. So it's more prospective on that front, but they are not the sectors. Alex, do you want to say something?
And just to add to that, I mean, with our cash levels, let's say in the low 20% range, it really doesn't take that many new positions oftentimes to bring us down into that 10 to 20 range, or even towards the lower end of that range. So it's a reasonably concentrated fund, so we would only have to find half a handful of interesting stocks, and that can come about quite quickly.
Our next question is from Julie. What is the misunderstood element you see in Freedom Insurance? I left the AGM and sold my holding. What am I missing?
Hi, Julie. Thanks. We also have a question from William on Freedom Insurance, asking whether our views have changed through the Royal Commission. So a couple of questions on this one. Look, the first one in terms of value is it's a very similar business to iSelect that Alex talked about earlier, to Lotto 24 that we owned in the international fund, in that there's a lot of upfront expense in acquiring a customer, and in the case of both Freedom and iSelect, there's a long trail of cash flow that comes after the revenue has been booked up front. So if you look at this business over the past few years, they've recorded some fairly meaningful accounting profits, but the cash flow wasn't great. That cash is going to come in future, whether they keep recording accounting profits or not. I actually think the business can grow. I think that space in the insurance sector, given all of the pressure that's on the banks and the vertically integrated players, it's creating opportunities for businesses like Real Insurance and Freedom Insurance. I'm actually a fan of the founding shareholder and managing director. I know he doesn't come across as particularly salesy, but particularly in the insurance business, I like that. And look, the Royal Commission, there's some things in there that are concerning, but importantly, they're buying a business here called St Andrews from the Bank of Queensland. It actually was supposed to put in a submission to the Royal Commission because one of the companies that has been selling its products was in trouble, but that's an important distinction. It wasn't actually St Andrews in trouble, it was the company that was selling their products. And from what we could tell, it looked reasonably positive in terms of St Andrews trying to get the company that was selling its policies to do the right thing. So I think that whole space there's potential and likely regulatory pressure, but we feel that Freedom's reasonably well placed to handle that.
Our next question is from Gabby. What are your views on China, and do you invest in that market?
Thanks, Gabby. Look, we've had a fairly long-held concern about the nature of the growth in China, particularly the levels of debt being taken on to sustain that growth. So we are conservative about it. That doesn't mean we don't invest there. Just to our risk management slide earlier, we just try and mitigate the potential impacts of any downturn on our portfolio. We own Baidu, which is the Google of China, and we own a couple of Hong Kong listed businesses, one of which is effectively sourcing product for the American kitchenware companies, and the other is a local real estate agent business in China. You can imagine, given our concerns, that we want that stock to be trading at an extremely low price, but it is doing that and has a very strong balance sheet. Just in terms of the whole presentation today, we want to invest where we feel like we've got some sort of informational edge, and it's very, very rare and hard for us to get that in China. So the exposures there are quite small, and you shouldn't expect it to ever be particularly significant.
Our next question is from William. Do you believe Thorn has any competitive advantages over peers?
So I might take that one. Hi, it's Alex here. So I think it's a matter of which division of Thorns you are talking about there. So Thorn at the moment is a combination of an equipment finance business, and we actually don't think it has much of an edge. It distributes predominantly through brokers, and they've done a good job growing that business over time, but we're of the view that they, much like some of the other businesses that they've disposed of over the last year and a half, that they should be selling that one as well. Now, the other side of a business, radio rentals, is we actually do think they do have something there. They've got brands, they've got clients that that have used them over time and do come back to them, and they're offering something reasonably unique to a segment of the population that needs that product. So yes, I think in that part, yes, but in the former equipment finance, no.
That concludes our annual Roadshow webinar. Many apologies if you asked a question and we didn't get to it. An audio recording will be available on our YouTube channel in a few days' time for those of you who would like to view it again. Thanks to everyone for your attendance.